Let's see. Secrets to resumes. Hopefully you guys understand that the goal of getting an MBA is to get a job, right? And so let's talk about some of the things that people put on resumes and whether they are good things to do or not. First of all, what do you think about objectives?
Like a paragraph?
Yeah, so there's like an objective statement. Have you guys seen those before?
No.
Absolutely. Stay away from that. Okay, so a lot of times when you're at a career fair, are you handing out cover letters? No, you're handing out. So a lot of people, and so here's what the objective statements that I've seen look like. I am looking for a financially rewarding job that requires very little effort on my behalf and will allow me to pursue my passion of bicycling or whatever the hell. And you know what I say when I see that? I'm like, good luck. And it goes into file 13, or the round file. Do you guys know about the round file? It's the trash can, right? Yeah. Okay, by the way, when you've got 1,000 resumes, what's the first thing you do? You got to narrow it down.
The university.
What's that?
My college.
Oh, well, no, the first thing I'm going to do is go through and look for people who've sent me email addresses that say like gmail.edu. I obviously know they're an idiot, right? Because there's no such thing. And I toss them out. And spelling errors?
No.
Whoop. How about using multiple fonts?
No.
Whoop. Comic Sans MS.
Welcome to the top.
Yeah. Okay. This is from a man with a mustache, so it tells you where he's coming from, right? Okay, so don't do that crap. By the way, the objective, even if you've got a great one, so remember, it's all about what you can do for them, not what they can do for you. And so the objective is really too much about you, and it narrows things down. When they say that they want a challenging opportunity in sales, I'm like, whew, this isn't the place for you because our stuff sells itself. So, whoop, right? Don't do that. Don't put an objective. Now, personal traits. Have you seen this where it says, self-starter, dedicated team member, the natural-born leader? Do you know what I say when I read that? Horse shit. Actually, no, this is bullshit. This is bullshit, right? And if you don't know, as a non-American, if you don't know the difference between horse shit and bullshit, ask an American friend. Horse shit is basically, well, never mind. Okay, you can look it up later. Okay, so I could say, look at this. I could say, I'm 7 foot tall. There's no way I can credibly certify on my resume any of this being true, right? And if you do have personal traits that are negative, does anyone put flaming arsehole? No. And so those are worthless too. Action. So let's talk about what you do want. You want action verbs. I led a team of 112 people to launch a new blah, 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 right? Concrete, and use action verbs. Don't write crap in passive tense. It's all about what you've done, right? Concrete accomplishments. I created $2.12 million in additional shareholder value through my work as the capital budgeting director for blah, blah, blah. I reduced shoplifting at the convenience store where I work by 37% through my extended diligence and monitoring of security cameras. Action, right? Now, I heard you guys talking about people including pictures in resumes. Is that a good idea?
No.
That's not a resume. That's like a portfolio or whatever. Yeah. I don't mean to rain on your parade, but you're striking out today. There's the mustache and well, anyway. Okay. Okay. And the answer is this. It depends on where you are at. In Vietnam, do they ask for a picture on it?
Some role, some position.
Yeah. So in Asia, it's actually common, right? So Singapore and Vietnam, Hong Kong. So I've got this friend from Hong Kong, lovely person, but she's not attractive. And she knows it. And she said, we asked her, why did you go to work for the government in Hong Kong? And she said, because they were the only people who didn't require a picture with a resume. She's brilliant. And strangely enough, her kids are attractive. But, you know, she knew she just was not the kind of person that was going to get sold based on their pictures, so she went to the government. Does that make sense? Now, you are an American, or let's say you are applying for a job in the United States. Do you include a picture?
No.
No. And in fact, we kind of frown on that because of the potential for discrimination, right? Okay, so I'm going to leave that one. It depends, right? Whether you should include a picture or not. Any questions?
I got mine if you want.
Oh, you got your resume?
That was the job fair.
Oh, yes. How many of you went to the career fair yesterday? Did you guys make any contacts? Yeah. So, I meant to mention it last time, but anytime you get an opportunity to go to something like that, go. Shake hands, talk to people, and you're going to develop the ability to do that more and more easily, more and more comfortably. It's the weirdest thing in the world to walk up to a stranger and start doing that sort of stuff. That's why they serve alcohol in nightclubs, right? Make it a little easier. We don't do that for the career fair. Maybe we should, I don't know. Okay, questions? Okay, last time we were on bond ratings. Can anyone tell me what two colors up here represent investment grade bonds?
Blue and green.
Blue and green. And what two colors represent junk? Yellow and red. Now, should you ever buy a junk bond? It depends. And so I will say that I would not buy one of those defaulted bonds unless I was doing vulture capitalism. But would I buy any of the other junk bonds? Absolutely. Here's why. First of all, do you think they're all going to go belly up at the same time? No. So the key to it is to hold a diversified portfolio of junk bonds, a diversified portfolio. Now, if I'm holding a diversified portfolio, I know that historically 95 to 96% of junk bonds pay as promised, right? And so I can afford losing that little bit, that 4 to 5% of my capital, because what's going on with the yield and maturity for these things? Yield and maturity. It's going to be higher, right? The coupons are going to be higher. So you're making up for it. In fact, do you guys know Russ Meek? Yeah, so Russ is a financial advisor, and he actually helps people retire, or he used to. He's kind of retired now. But he would put people in junk bonds. And when you first hear that, it sounds asinine. But when you realize that if you hold them in a diversified portfolio and that 95 to 96% of them pay as promised, then you're good to go. Does that make sense? Okay. Now let's talk about some different types of bonds. Well, in the United States we have government bonds, and we have, as our national government, we call it our federal government. That's our central government. And they have some debt that they issue. First of all, they issue treasury bills. Treasury bills are up to 1 year, but the most common one is 3 months. They have no coupons, which means that they are a pure discount bond, which means in times of positive yields, they will always sell at a discount. Then we have treasury notes. Treasury notes are greater than 1 year up to 10 years, and they actually do have coupons. And in fact, so do treasury bonds. They have semi-annual coupons. What's the difference between the note and the bond?
The length of time.
Yeah, the original issue time to maturity. So with the treasury bonds, it's greater than 10 up to 30 years. We talked at one time about doing 40-year bonds, but that kind of went away. Now, as an investor, why would you be interested in these? First of all, in theory, no default risk, right? Secondly, they are free of state taxes. So the federal government, it's really funny, they say, hey, we're paying this person interest on money they loaned us. States, you're not allowed to tax it, but we will. You will be paying federal income tax on these bonds. Okay, now, everything below the federal level, we're talking about states, cities, special districts like school districts and sewer districts, they all issue what is known as municipal debt or municipal bonds. They are free of federal tax, And depending on where you live and where the bond was issued, may be free of state tax. For instance, if I buy municipal bonds from a Missouri issuing entity, I don't have to pay any taxes on that, state or federal. However, if my mother-in-law, who lives in Arkansas, buys the exact same bond, she will be paying Arkansas state tax. She could buy an Arkansas-issued bond and get by with not paying state tax, but if I bought the same bond, I would have to pay Missouri state tax on that Arkansas bond interest. And so, when you look at municipal bonds you're thinking about buying, it makes sense to take these sorts of things into account. Because after all, people are interested in after-tax return. People are interested in after-tax return. Now, if something is tax-free, then the before-tax return is the same as the after-tax return. And as a result, the before-tax return of these tax-free things, the required return is going to be lower because people aren't going to have to pay taxes on it. So, bonds that do not incur taxes don't have to return as much, and we have this formula. I sub M. What do you think the sub M stands for? Municipal. That's the interest on the municipal bond is equal to I sub T. What do you think T stands for? Taxable. Multiplied by 1 minus big T. What do you think big T is? That's the marginal tax rate of the investor. So whatever you're going to have to pay on the next dollar that you earn, that's going to be it. Now let's think through this. First of all, these bonds have to be otherwise identical. They've got to have the same amount of time to maturity. They've got to have the same default risk. Everything's got to be the same. So it's got to be a ceteris paribus argument in order for this equation to hold. Now let's think about the kind of people who would like to invest in municipal bonds. The people with the highest marginal tax rate will be the ones who are most interested. And here's why. Because it's 1 minus T multiplied by that taxable bond rate. The higher T is, the bigger the difference between I sub M and I sub T. So I'll give you an example. My brother-in-law, he drives a propane truck. He makes a good living, but he has a boatload of kids. He's got 4 kids. Now, here's the fun thing about the United States government. Apparently they want you to have kids. And so they give you tax breaks for having kids. And so after he takes advantage of all his tax breaks, his marginal tax rate is basically 0. Would he have any preference for municipal bonds at all? No. And the same is true of things that don't have to pay taxes. For instance, pension funds and charitable trusts. If I saw either one of those groups investing in municipal bonds, I would want to have a talk with their people because they're leaving money on the table. Because it's all this money's out there competing. Okay, now let's talk about the higher the tax rate, the more the difference is. For example, if the tax rate is only 20% and the taxable bond pays 10%, then the municipal bond has to pay 8%. But what if the tax rate is 40%? Then the municipal bond only has to pay 6% to be as attractive as the 10% taxable bond. And so it allows these localities to borrow at cheaper than the market rate, and the people who are truly attracted to these are the people with the highest marginal tax rate. Who are the people with the highest marginal tax rate? Yeah, high income people. So when my wife and I first moved to Springfield, this is back in the days when you had landline telephones, the phone rings, I pick it up and they say, "Dr. Haggard?" And I say, "Yes." "This is Frank so-and-so from Edward Jones." I'm like, I hate cold calls. And he says, "I want to talk to you about municipal bonds." And I say, "Wait just a minute." And I cover the mouthpiece on the phone. And I turn to my wife and I say, "Honey, we've made it. Edward Jones thinks we have enough money to care about municipal bonds." Then I uncover the mouthpiece and I say, "Thank you for calling, but no thanks," and I hang up. Okay, so rich people are the ones, or people with high incomes are the ones that want these things. Questions? I hope at some point in your life that you are at a place where municipal bonds are extraordinarily attractive to you. And I also hope that you will remember your alma mater with your kind charitable donations at that point, which, by the way, are also tax deductible. Okay, so let's talk about some other different types of bonds. We've talked about zero coupon bonds. What's the coupon rate on a zero coupon bond? Zero, right? All the principal and interest are paid back at the maturity. They must always be a discount bond as long as rates of return are positive. It's so funny, when I first started giving this talk, I never had to worry about negative yields. But then the financial crisis came around. And then they upped the deposit insurance limit to $250,000, but that's still not enough for a lot of people. And so people started pouring into government bonds, which they thought were safe, especially German government bonds, because the Germans used to be far healthier than they are now. German government bonds, and the yield actually went negative. People were paying more than face value for bonds that paid no coupons. Why? At that point, it's not a matter of getting a return on your capital, it's getting a return of your capital, right? Because you're scared snotless, and that's the safest place you can park your money. Okay, so that you got to take this with a grain of salt, that it must always be a discount bond as long as rates of return are positive. And we call these things either zeros or deep discount bonds. So you could have discount bonds that would have skinny coupons, and then these zero ones are deep discount bonds. And then we have floating rate bonds. Remember I told you that the coupon rates stay the same throughout the life of the bond, except for some weird bonds? Well, these are the weird bonds. Floating rate coupons are tagged on to a base rate, usually something like the 10-year United States Treasury yield. And there's going to be an adder on top of that, because these companies that are borrowing, of course, they have default risk. And so that has to be thrown on there, that default risk. And so that's going to be what determines your coupons. The whole idea is to get the yield to the coupon rate to float exactly with the yield to maturity. And if you can get that to happen, what does that mean for the price of the bond? Yeah, it always stays at face value or really close to it. So basically what we're doing is taking the price or interest rate risk, we're taking that off of the lender and putting it onto the borrower. Does that make sense? Because if I've got these floating rate coupons, then I don't have to worry about taking a capital loss over the life of the bond. Now, what does that mean? If they are taking the risk off of me, I'm going to demand a lower yield to maturity. And so they're getting rewarded with lower cost of borrowing for taking on that additional risk. Then we have income bonds. Income bonds are extraordinarily rare, and thank God for it. Here's what an income bond is. The income bond says, we'll pay you a coupon if our earnings are above a certain point. Now here's what you need to know about the generally accepted accounting principles and managerial discretion. If they had to have $10 million in net income in order to have to pay these coupons, what do you think the net income would come in at? $9.9 million, right? And how are they going to do that? They're going to do it with accruals. They're going to do all sorts of crap. And I've been on the receiving end of this before, where it's like, oh, sorry, the bonus was going to kick in here, but darn. And then the next year they reverse the accruals, and it's all bad for me. Anyway, long story short, income bonds, to me, sound a lot like your friend who wants to borrow money. And I'll use Mr. Long for an example. Mr. Long comes to me and wants to borrow $100. And I say, when are you going to pay me back? He says, when I get a job. Who totally controls when he gets a job? He does, right? Do you loan money to people like that? I hope not. So, don't do income bonds. The last time we really saw these in a big way was in the 1970s when the railroads were going belly up. Then we have convertible bonds. A convertible bond is looks like an ordinary regular bond, except for one thing. You can convert it into shares of common stock. You can convert it into shares of common stock. So let's say right now that the stock was at $20 per share. And the bond sells for $1,000. And I say, in the language of the bond, I say, well, you can convert this into 40 shares. You can convert that bond into 40 shares. What value does that put on each share? Yeah, 25. Now, would I go out, buy this bond, and then immediately convert it into shares? No, that's stupid, right? When would it be useful for me to convert this bond into shares? When the price goes above 25, right? When the price goes above 25. Now, here's the problem. Convertibility is a one-way street. You pull the trigger and it's done. So when would I advise you to pull that trigger? When you are ready to sell the shares. Let's say the price is at $30 a share. I would convert the bond and then immediately sell the shares. Otherwise, what might happen? Yeah, stock price could drop. And if it dropped back below $25 a share, you'd actually now be at a loss. Does that make sense? Okay, now, here's the fun thing. What happens if the stock price goes to $100? That's like winning the freaking lottery, isn't it? For the bondholder. And so you can think of convertible bonds as being a regular bond with a lottery ticket stapled to them. How many of you ever bought a lottery ticket? Did you have to pay money for that? Yeah. Are people willing to pay money for lottery tickets? Yeah. Now, the way that people pay for the lottery ticket on a convertible bond is through their lower required return. And so you could have two identical bonds, otherwise identical bond. The one with the convertibility lottery ticket on it will have a lower required yield to maturity because people are also pricing in the possibility of winning the lottery. Now, what is the goal of financial management? Maximize shareholder wealth. So here I am, I'm the CEO, or the CEO, let's say I'm the CFO. When would I issue convertible bonds versus straight bonds? When everyone else thinks the stock is about to take off, but I know it's not. Does that make sense? When everybody else thinks it's going to take off, they're going to value that lottery ticket highly. They're going to reduce the amount of return they require. As a result, it's going to lower my borrowing cost. Is that scumbaggy?
Yep.
Do you think people make decisions like that all the time? Yeah. Okay. That means that when I see an issue of convertible bonds, I view that as somewhat of a negative signal because they're basically, well, you catch what's going on here. The investors are more optimistic about the company than the company is. Why would the company not want to issue convertible bonds if they thought things were going to take off? Because when people convert, their new shares are added to the total overall shares of the company. And what does that do to the earnings per share then? The number of shares goes up, earnings per share goes down. We are diluting our current shareholders. By the way, the goal of financial management is that obligation is to the current shareholders, not to future shareholders, just to my current group. Okay, then we have what are called put bonds. She has permission to go. Is the baby coming?
Baby.
Yep. We'll look for a report when you come back. Okay. By the way, it's her sister. It's not her, right? Just in case you didn't know. I mean, she doesn't look pregnant, but I actually knew a girl who never did look pregnant, and she was surprised when she had the baby, and we all were, right? It was a tiny baby. It was weird. Okay, back to the story. Let's talk about put bonds. So you've probably heard of put options before. That's where you can force someone to buy something at a certain price at a certain time in the future. A put bond allows bond holders to force the bond issuers to buy the bonds back. By the way, so this is, we talked about callable bonds earlier, and we said there was a call premium. Well, when you got put bonds, there's going to be a discount. And so it's basically, if this thing gets down to, say, $900, if it gets to below 900, you can force them to buy it back from you at $900. So basically, this puts a floor to your capital losses, in theory. I say in theory, and here's why. If the bond values are down, not because of overall interest rates dropping, but because the company's in trouble, what does that mean for their ability to go out and raise new money to pay you your $900? They might not be able to. And so it sounds nice. It is some protection, but is it perfect protection? No. You might still end up losing more than $100. Now, this insurance allows them to, because they are taking a risk off of the borrower or the lenders, they're taking risk off the bond holders. What do you think happens to the yield to maturity that those bond holders require? Yeah, they're not going to require as much because they've got this little insurance policy. So we had the lottery tickets on the convertible bonds, and we had the insurance policy on this one. And keep in mind the callable bond, that option belongs to the bond issuer, therefore it's riskier for the bond holder, therefore they require a higher yield to maturity. Here, the option belongs to the bond holder, makes it less risky for them, so they require lower yield to maturity. Now, as a manager, my job is to maximize shareholder wealth. So in deciding to issue put bonds, when would I do it? When everyone thinks the company is getting ready to take a giant dump, but I'm confident that it's not, right? I'm confident I'm not going to have to buy those bonds back. I'm confident that things are going to take off. But in the meantime, by putting this little insurance policy out there, I've lowered my borrowing costs, which maximizes shareholder wealth. Questions? Okay. Now let's talk about bond markets. If you see a bunch of people on a floor somewhere yelling stuff and flashing fingers, that's not the bond market. The bond market is over the counter. Now, how does this bond market get this name over the counter? In the beginning, when you wanted to buy a bond, you would go to your broker, and they would be standing behind a counter, and you would say, I would like to buy a 30-year General Electric bond. And they would reach under the counter and hand you the bond over the counter, and you would hand them the money. Now, how have things progressed? Well, now bonds are electronic. Is there actually a counter anymore? No, but we still call it OTC, over the counter. Now, who are you buying from? You're not actually buying from the issuer of the bond. You're buying from dealers. What is the definition of a dealer? It's someone who holds an inventory and stands ready to buy or sell. It's someone who holds an inventory and stands ready to buy or sell. Now, let's talk about some examples of dealers, and I don't want to hear poker or blackjack. Give me an example of a dealer. Yeah, car dealer. Does a car dealer hold an inventory? Yeah. Do they stand ready to sell? Yeah. Do they stand ready to buy? Yeah, and not just from a trade-in perspective. I actually sold my old car to Youngblood Nissan. I sold it to it because they had taken care of it. They knew it was a good car, right? I sold it to them and got my money. And so they are a perfect definition of a dealer. What else?
So I'll just say a drug dealer.
A drug dealer, very good. Does a drug dealer hold an inventory?
Yeah.
Yeah. Do they stand ready to sell?
Yeah.
Always. Do they stand ready to buy? Oh yeah, I guarantee if you go up and you're like, hey dude, I got some really good stuff here, and your price was right, they would buy, right? Okay, now, How does that differ from real estate?
Real estate doesn't hold.
Yeah, the realtor does not hold the inventory. The realtors are merely brokers. Brokers are people who just connect buyers and sellers. They never hold the inventory. Question?
Commission, please.
Oh, yeah. And so that brings us to a good point. Thank you. So brokers always have to get a commission. How do these dealers get paid? Well, it's the difference between the bid price and the ask price. The bid price is going to be lower. So I will bid to buy your bond at $998, but when I turn around and ask someone else to buy it, I'm going to charge them $1,001. And that difference between those two prices is called the bid-ask spread, and that's how dealers make their money. That's how dealers make their money, is that bid-ask spread. Now, if you are holding an inventory and stand ready to buy or sell, we say you are making a market. All the idea of a market is that I have the ability to go buy or sell whenever I want, and as long as there's a dealer out there holding an inventory, standing ready to buy or sell, we say they are making a market. Is the baby here?
Not yet, but very close.
Oh, very good. Okay. Any questions?
So is the bid-ask spread the commission, I guess, that the dealer makes? Or
No, it's not a commission. It's like when, so think of a fruit vendor going out and buying apples for $0.25 and selling them for 28 cents. We wouldn't call that 3 cents difference a commission. Does that make sense? So it's basically like they're buying an inventory of apples and then selling that inventory. And of course, being a good business woman, you got to charge more than you pay for. That's how you make money, right? What's that? Profit, yeah. So that's how they profit, is that bid-ask spread. Now, I hate the fact that it says bid-ask, because it's actually ask minus bid, right? Because the ask price is higher than the bid. And we're going to see this again when we talk about stocks. Any questions so far?
Is a bank a dealer or a broker?
Bank, a dealer, or a broker? Actually, so banks, so they have some provide services, like brokerage services. And I imagine that you could, see, the question is, are they holding securities available for sale? I think the majority of them do, and so in theory that would make them dealers. Maybe, I don't know. That's a good question. I'm sorry I don't have a great answer for you. I will look it up and we'll talk about it next time. By the way, how many hats do you own? Because you have like a different hat every day. 3? So you've got the Mercedes one, you've got that one? Okay. Okay, so we're going, oh, sorry, well, I had guys drawn down the hat rabbit hole.
Would the bid-ask spread be lower for treasury bonds?
Ah, very good. So the bid-ask spread is not the same for everything. So the riskier something is, the bigger the bid-ask spread's going to be. And we know that corporate bonds are riskier, which means that their prices can move more quickly, which means that during this time you're holding on to this inventory, you've got more inventory risk. By the way, though, do you think dealers would find a way to hedge against inventory risk? Yeah, they're not in the business of making money from the value of their inventory going up, because it's just as likely that it will go down, right? And so they're going to hedge against that kind of risk using futures and what, interest rate futures. That is a whole different class. Ms. Sego, have you had background in that?
a little bit?
A little bit. Does she look happy for having been through that? No, she looks kind of drained. Okay. Other questions? Okay, next we're going to look at some treasury bonds. And you can tell this is a slide that has been around a while because these bonds were all still outstanding when the slide was made. The first one says maturity is June 30th, 2014. Now, at that time, this wasn't that far out in the future. So the maturity date is down the left side. And the next thing is the coupon rate in percentage of face value. The coupon rate in percentage of face value. Of course, you know that's how coupon rate is stated anyway, but you'll see here in a second that that percentage of face value is going to become important. And then we have our bid and our ask. Which one is higher? Ask, always, always. It's so funny, on Yahoo Finance, I think they've got them reversed for stocks, and they're always showing one to be the opposite of what it should be. It's just sad, and it's been that way for years. Okay, so now the next thing you need to know is that these prices are not dollars. The bid and the ask price are in percentage of face value. The bid and the ask are in percentage of face value. Now, here's something fun. If you think back to when we talked about current yield, we said that that was equal to the annual coupon divided by the face value. And the annual coupon is the coupon rate. Oh no, it's not face value, it's price, right? Sorry about that. So the coupon rate times the face value gives me that annual coupon. Now, if I take these prices, which are percentages of face value, and I multiply them by the face value, then I get the price. Here's the fun thing. What happens to face value over here on the right? It cancels out. And so if you want to know the current yield on a bond and you've got a quote like this, all you've got to do is take the coupon rate and divide it by the asked price quote. All you got to do is take the coupon rate and divide it by the asked price quote, because after all, those are in percentage of face value. Now, why the ask and not the bid? Yeah, you're going to buy at the ask. By the way, when someone says that there are two prices for this thing, always assume that you're going to pay the top one, right? And if you sell to them, you're going to get the lower one. Questions so far? Okay, now, the next thing says CHG. What do you think CHG means? Change. This is change from the market's close on the previous day. In accounting and finance, what does red mean? Negative. Unless you're in China, and then it would be green for negative, red for positive. Why? Ms. Gann, do you know?
Because red's supposed to be lucky.
Yeah, red's lucky. So I'm visiting the Dalian Stock Exchange, which is not that big. And these guys are standing in front of the boards, and they're all red, and they're like, woohoo! I'm like, you're insane! And then someone pointed this little fact out to me. Okay, so if you see them crying, you know the board's green. Okay, so here we go. What do we know? By the way, these are all red, which means that the price is down from yesterday. What must have happened to interest rates yesterday? Yeah, they got to go up, right? So interest rates yesterday went up. And then the last thing we could actually, if we knew the date of this quote, we could actually calculate the yield to maturity given the information that we have here, and we would get this asked yield. That is the yield to maturity based on the ask price. That's the yield to maturity based on the ask price. And you can do a little bit of inflation archaeology by looking at bond prices. And so you can see when the inflation is higher, interest rates are higher, and the bonds will have higher coupons, because after all, they're trying to issue them with coupons that will be the same as the required yield to maturity, so they'll sell at face value. So you can kind of do a little bit of inflation archaeology by looking at these bond coupon percentages. Are there any questions? Okay. So on your note sheet, in addition to annual coupon divided by price, you can put coupon rate divided by the price quote, and you would be good to go. Now let's talk about inflation and interest rates. So when we talk about real returns, we're talking about an increase in your purchasing power. On January 1st, I had enough money to buy 10 pepperoni pizzas. On December 31st, I had enough money to buy 11 pepperoni pizzas. 11 minus 10 divided by 10. What is my real rate of return? 10%. Now you notice I didn't say anything about money there. I didn't say anything about dollars or yuan or euros. It's all in terms of your ability to consume. Then we have nominal returns, which represent an increase in the number of dollars. All the returns that you see, so when you go down to the bank and you look at the interest rates on CD, those are all nominal interest rates. And they already include an expectation for inflation. If you loan someone money at 5% and then inflation is 7%, you've actually got a negative real return. You'll be able to consume less at the end than you could have at the beginning. So how do we relate these two? We have something called the Fisher effect. The Fisher effect. Let's define some of these things. You've got big R, which is your nominal rate. Big R is the nominal rate. That's the one that includes an adjustment for inflation. Little r is the real return. Little r is the real return. And H is inflation. Why the H would we use H for inflation? Why don't we use I? Yeah, and we get it confused with interest. Now, some professors use pi. Dr. Whitty uses pi, I believe. Now, do you know why I don't use pi? Because some idiot undoubtedly will put in 3.1, right? Okay, so H is inflation. Now, you can solve this for any one of those, for big R, for little r, for H. You can solve it for any of them. And and by the way, if you're lousy at algebra, do you think you and a friend should try to solve those beforehand so you'll have the ability? Yeah, go ahead and do that and have it on your note sheet. Now, in my class, you will always use that Fisher effect equation. After work, when you are at the bar discussing real rates and nominal rates with your besties, like you always do, at that point, it's okay to use the approximation, which is just the real rate plus H. Now, here's the problem. If I do the math out, what I would figure out is that big R is actually equal to little r plus H plus R times H. If R and H are small, that approximation's fairly good. If R and H are large, that approximation sucks. When you're investing millions of dollars, which one would you use? Yeah, use the Fisher effect. Use the exact. That approximation, that's just you and your friends hanging out making jokes about interest rates. Questions? Okay. In the end, what do we really care about? Real rates, because that talks about our ability to increase our consumption. Why am I delaying consumption now? So I can consume more later. Now let's talk about the term structure of interest rates. The term structure of interest rates is the relationship between time to maturity and the interest rate. And typically, 95% of the time, what we see is this upward sloping term structure. And this term structure, this is for United States Treasury debt. And in fact, what they've done is they have, this is going to get complex, so I'll try to make it easy. We have these things called strips, separate trading of registered interest and principal. And so basically what they do is take a 30-year bond and they sell each coupon individually as basically a zero coupon bond of its own. And so you could get the coupon that's 12 years out, and it would be basically like a zero coupon bond that paid the face value of the coupon in 12 years. Now, why is that important? Because we have, using that information, we have the true return required at each point along this path. Is there any default risk? No. It's pure interest rate risk and inflation premium and real return, which we'll get to that in a second. Now, when inflation is high, what does the Federal Reserve do to try to kill it off? What have they been doing lately? Yeah, they raise interest rates. And where do they raise them? The short term. They raise the interest rates in the short term. Now, how does raising interest rates get inflation down? It pulls money off the street. It pulls money off the street because suddenly it's worth more for you to keep your money in the bank than to go out and buy a new car. My grandfather had a 1977, and so this actually probably 1979, early 79. I said, Grandpa, why do you drive that car? You could buy a much nicer car. He was a wealthy man. You could buy a nicer car. You could buy a newer car. And he said, are you kidding me? I'm getting 17% on my money in the bank. He says, I'm going to drive the car till the wheels come off. Right? Does that make sense? And so by the fact that he was not out there in the market buying a car, that reduces demand for cars. What is that going to do to the price of cars? Yeah, it got to come down, right? And so this is how you kill inflation. But the bad news is that leads to this inverted yield term structure. Now let's talk about why that's bad news. The answer is that that top picture is how banks make money. That top structure is how banks make money. The money that banks loan out, where do they get it?
From people putting money in the bank.
Yeah, depositors, right? And those deposits are typically short term. So your checking account, short term. Your savings account, short term. Even CDs, you'll only see them going out to like 5 years. And so they're paying interest rates down here on the low end of the curve in normal times. What do they turn around and do though? They loan that money out in the long term. And that difference between the money that they're bringing in off those long-term loans and the interest that they're paying out on the short term, that's how they make their money. So 95% of the time, having a bank, it's a profit machine. What happens though when things go the other way?
They don't have enough money to lend out.
Well,
Well, people aren't putting as much in, and so they don't have
or,
access to
well, so they're putting money in at the short term, but the banks happen to pay,
the long term.
yeah, well, the banks happen to pay more, right?
Yeah.
And so if you get on this bottom picture here, the bank's actually paying more for the money than they're getting. So I'll roll you back to the mid-1970s. The mortgage rate was in the 7% neighborhood. And then inflation hits, the Federal Reserve does the trick here in picture B, and suddenly mortgage rates shoot up to like 18%, and the short term was like not that far behind it. And so we had this kind of situation here. Now, here's the fun thing. Banker calls, because of course they're still only making 7% on those 30-year loans that they had given out like 2 years before. Banker calls my dad's buddy Steve and says, hey Steve, I see you got your mortgage there. How would you like to refinance that? He's got a 7-year, 7% mortgage, and he's going to have to refinance to 18%. What do you think the response was? Do you think I'm a flippin' idiot? Right? Now, what happens on the other flip side of that though? When we first moved to Springfield, our mortgage rate was 8%. Frankly, because we had no money and we were really risky, right? But it was 8%. What do you think I did as soon as I could? Yeah, I refinanced it to a lower rate. And so what you'll see is people holding on, and it's going on right now. I got a 3.375% mortgage. My wife says, hey, what would you think about buying another house? I'm like, no way, because you don't get to take the mortgage with you, right? You don't get to transfer it to your next house. Okay, now let's talk about what all goes into this term structure of interest rates. First of all, on the very bottom, we have the real rate. And we have no theoretical reason to believe that the real rate changes with time to maturity. So we just assume that that's flat all the way across. And the second layer of the layer cake is the inflation premium. So that shows you what the expectation of inflation is over that time period. And in fact, you can actually go into the bond markets for United States Treasuries and figure out what is the market's expectation for inflation. If it's going up, then this is going to improve or increase this upward term sloping nature. Now, what happens if the inflation premium is perfectly flat? We expect inflation to stay the same for the entire life of the bond. Then we still have an upward sloping term structure because of the top layer of the cake, and that is interest rate risk. We know that interest rate risk increases with time to maturity. We know that interest rate risk increases with time to maturity, but I want you to notice something. It increases, but at a decreasing rate. It increases, but at a decreasing rate, and that's why you see that curve there on the top. So that top picture represents what's normally going on. Even if the inflation premium were totally flat, we would still have an upward sloping term structure because of interest rate risk. And we might even have an inflation premium that's coming down slightly and still have an upward term structure because of the interest rate risk. Now let's take a look at what goes on the bottom. Real rate's the same. The inflation premium is high now because we are currently experiencing inflation. But if the Federal Reserve is attacking inflation, what does that do to our expectations for inflation in the future? Yeah, they go down. So that's why you see that inflation premium going down over time. And if that inflation premium is going down faster than the interest rate risk is going up, then we end up with a downward sloping term structure. Every time we see a downward sloping term structure for any amount of time, a substantial amount of time, then we end up with bank failures. And you understand totally why that is now, because they're having to pay 18% for money that they're loaning out at 7%. That's like a business model where you are paying 30 cents for apples and selling them for a nickel. It's just not good business. Questions? Okay. Now let's talk about the determinants of bond yields. So we're going to start out with the layer cake, the three things that we just talked about. And then we are going to throw what's called a default risk premium on top of that. Because remember, that term structure of interest rates is for United States Treasury debt. In theory, it's default risk free. So if you are a corporate borrower or even like the city of Springfield borrowing money, there's going to be a default risk premium that goes on top of that. And then there's what we call the taxability premium. Earlier we said that the interest on a municipal bond was equal to the interest on a taxable bond multiplied by what?
1 minus T.
Yeah, 1 minus T. Very good. Okay. Now, and we say that the municipal bond has a lower interest rate. The other way I could look at that is to rearrange this thing and say I sub T is equal to I sub M divided by 1 minus T. And this I sub T is going to be higher than that I sub M. We would call the difference the taxability premium. The taxability premium. By the way, this I sub T has another name. It's the taxable equivalent yield. Taxable equivalent yield. So if you ever see anyone, or on a homework or test question, where it talks about the TEY, that's the taxable equivalent yield. That's just I sub T. That's just I sub T. It's how we take a municipal bond and figure out what it would cost us if it were taxable. What would the required return be? Any questions so far? Okay, the final thing we're going to look at, and your book calls it the liquidity premium, but I'm actually going to call it the illiquidity premium. And after we get through talking, you'll understand why. If something is liquid, we say that we can sell it quickly at or near the full market value. If it's liquid, we can sell it quickly at or near its full market value. If I've got a bond that is publicly traded, it's very liquid because I can always sell it and I can do it very quickly and I can do it at the full market value. But what if a bond is not publicly tradable? Then I need to find someone to buy that bond. Hopefully I can find a dealer who's making a market in that, but it's not going to be easy to do, especially if stuff like Springfield School District bonds. You know, if you're pretty much stuck holding on to those until they mature, unless you've got a friend that just happens to want those, right? Okay, now, knowing that, which one of those do you think requires a higher yield to maturity? The liquid bond that I could sell at any minute, or the illiquid bond that I'm basically shackled to? Yeah, the illiquid bond is going to have that higher yield to maturity. That's why I call it an illiquidity premium. I'm going to tell you a story here, make an example that will bring this home to you. There's a young man, and the young man has $50,000. And he says to himself, I won't be needing this $50,000 for another 5 years. Maybe I should do something with it. And so he decides to go buy some bonds. And he goes to his local bond dealer and says, I've got $50,000 that I would like to invest for 5 years. And the bond dealer says, wow, have I got a good deal for you? He says, I've got these liquid bonds that have a 6% coupon rate on them. They're selling at face value. So what's the yield to maturity on them? 6%. He says, and I've got these illiquid bonds that have a 7% coupon rate. They're selling at face value. What's the yield to maturity on them? 7%. The young man says, well, I'm not going to need this money for the next 5 years. I might as well lock the money up and make the extra percent. Sounds good so far. Until he goes home that night and he's talking to his girlfriend. And his girlfriend says, I've been thinking. By the way, guys, when a woman says, I've been thinking, it means you're either going to spend money, you're going to do some work, or both. Probably both. Okay, so she says, I've been thinking we should get married. And he's like, yeah, I've been thinking that too. And she says, and, now it's getting worse, and I've been thinking I should have an engagement ring. For those of you who are not from the United States, the engagement ring, it's a diamond that you put on the lady's hand. What's the purpose? To mark your territory, right? And what is a more effective signal? A larger diamond. The bigger the diamond, the more effective it is in fending off other guys because they realize they can't afford as big a diamond as you did. Okay, now back to the story. She says, I want an engagement ring. He's like, great. And then he says, wait a minute. Where are we going to get this engagement ring? And she says, Cartier. Yeah. And he says, ooh. He says, how much is that going to cost me? $50,000. You're on fire. $50,000. He says, I've got good news. She says, what's the good news? He says, I have $50,000. You're just going to need to wait 5 years. How does the story end? The man, I try to put it in an optimistic way. The young man gets a new girlfriend. Right? That's the optimistic way to put that. So I have a friend. By the way, when I started telling the story, the number was 25,000. Because my friend that got married in 2006, she wanted a ring from Cartier, and it was going to be $25,000. And I said, do you realize that that's basically a Honda Accord on your finger? And she said, and of course, why is she thinking it's okay for someone to spend that money?
It's not.
It's not her money, right? It's the agency problem. I said, okay, think about it this way. Can you spot a Cartier ring when you see one? No. In fact, when my friends get married and they got the Tiffany, they have to hold the box so you can tell, right? I'm like, they should just sell the boxes, right? Okay, anyway, I said, look, we could take you to a jewelry store, a guy that I know, and we can get you just as good a diamond on a Cartier mount, which, by the way, you can buy anywhere. And people will never know as long as you don't tell them. And with the money that you save, you could buy a Honda Civic. They're still married. I feel that I was part of that. Okay, questions? Okay. Yeah, stock valuation. By the way, what's cheaper now, lab grown or natural? Lab grown. Can anybody tell by looking? No. And in fact, the only way you could tell is if you looked at it and it was flawless, you'd know it was grown in the lab. It's a no-brainer, right? Plus, no one had to die for it. If you don't know what that means, look it up. Okay, now let's talk about how we value stock. Remember, our basic valuation rule is that the price... Ladies, are you talking about engagement rings? She's like, I want a big one, right? And every lady is like that, right? You know, because we all want more and better, wouldn't it? Yeah. Now, one last thing on engagement rings. What do you think the correlation is between women that are willing to trade up their engagement ring and the divorce rate? Yeah, it's higher. A woman that's willing to... My wife's ring does not look like anything because I bought it for when I was 21, right? Doesn't look like anything, but she would not trade it for anything. A woman that's willing to trade up the ring is also willing to trade up her... There you go. Okay, price or value of anything. Present value of all the expected future cash flows discounted at a rate appropriate to the risk. Now, with the bonds, we said the cash flows were the coupons and the face value. With stock, it's the dividends that you collect and then the amount that you can sell the stock for at the end. So those are all the future cash flows of the stock. So it's really easy to value stock. All you've got to do is find the present value of the dividends and the proceed from the share of sales. So we start out with a very, very simple valuation model. And basically, we are just saying that the price today, which is times 0, is equal to the dividend at time 1 divided by 1 plus r. Why am I dividing by 1 plus r? If you get the present value, right? That's the present value of a 1 period. There's a tiny invisible 1 above that for t. Plus P1, which is the price at time 1, divide by 1 plus r. By the way, we always assume cash flows in finance happen at the end of the period, so we assume that D1 is at the end of the period, and P1 is 2. Now, that's solid. It's really easy, fairly easy, to figure out what D1 is going to be. What's the problem? Yeah, P1. Any of you who can tell me exactly what a stock price is going to be 1 year from today, come to my office. We will get rich together. Your brains, my money, we will get rich together. Now, you say, wait a minute, that's not going to work. So what can we do? Well, we can further break down P1. We can say, well, P1 is just D2 divided by 1 plus R plus P2 divided by 1 plus R. So I can substitute back into our original equation and say P0 is equal to D1 divided by 1 plus R plus D2 divided by 1 plus R squared plus P2 divided by 1 plus R squared. Now, what's the problem? P2, which is easier to know, P1 or P2? The weather forecast. Is it more accurate for tomorrow or for next week? Tomorrow. Is it more interesting, more accurate for next week or next year? Next week. Is it easier to know P1 or P2? P1. Now, I'm going to break Ms. Gann's heart here. Climate change stuff. It's all based on forecasting models. And how far out are they forecasting the weather? Yeah, so we're looking at like 100 years, right? Because yeah. If we can't get it right next week, what are the chances that that forecast for 100 years is accurate? Damn near zero. In fact, they've already changed that forecast a bunch of times, right? That's why we no longer call it global warming and we just call it climate change. Because the forecast keeps changing. Because it's out there so far. But it makes perfect sense. I'm sympathetic with your dad, right? He's trying to do something that other people can't do, and that's figure out what the hell's going to happen 100 years from now. It's really hard to do, right? And the same's true with stock prices. It's really hard to do. Now, what could we do? Well, we could just keep doing this thing over and over and over again until we push out that the price at which we sell the stock to the end of time. If I do the end of time, then the present value of that is going to be the price at the end of time. By the way, what's that symbol? Infinity. Divide by 1 plus r to infinity. Okay, now, as long as r is positive, if I take 1 plus r to the infinity, I'm going to get infinity, right? It's a flippin' huge number. This, though, is a finite number, a number you could actually comprehend. What happens when I take any finite number and divide it by infinity? Zero. So we basically push that thing out till the end of time, and we no longer have to worry about it. So we've solved one problem. Now, the problem, though, that we've created is that we have to figure out the present value of all the dividends between now and the end of time. Does that make sense? Because stocks are like some people I went to high school with. They never mature, right? It's kind of lame. Okay, so remember bonds mature, right? But stocks, in theory, as long as the company doesn't go belly up, never matures. Okay, so how are we going to do this? Well, we're going to look at 3 different models for how we can value stock using the dividends. We're going to look at zero dividend growth. Another name for zero dividend growth is constant dividends. Another name for zero dividend growth is constant dividends. And then we're going to talk about constant dividend growth, which is where the dividend grows at the same rate throughout all time. Constant dividend growth says that the dividend grows the same rate through all time. And then we end up with the one that everyone hates, differential dividend growth, otherwise known as supernormal growth. So in supernormal growth, in the beginning, you're going to be growing really fast, and then it'll level out to a constant dividend growth situation. Now, some of you are saying in your hearts right now, wait a minute, some stocks pay no dividends whatsoever, and yet they have positive stock values. Surely this means Dr. Haggard is full of crap. Except for one thing. It's the present value of all the expected future dividends. What do we expect that company to start doing? Yeah, paying dividends. And so let's think about the life cycle of a firm. In the beginning, you've got a magnificent idea, but do you have oodles and gobs of money? No. So everything the company earns needs to be reinvested back into the company. Okay, now the company grows, and eventually the cash that's coming in is more than enough to meet the investments needed for the positive NPV projects. And so the company starts paying a dividend. In the beginning, that dividend's actually pretty small, but it's going to grow pretty quickly. Then it will eventually settle out to a more constant growth rate. This is the story that we tell people about supernormal dividend growth. By the way, companies have life phases just like people, with one difference. The company doesn't necessarily have to decline and die. We do, right? Oh, so this constant, this differential dividend growth assumes that the company keeps going on forever. That's why we can expect that eventually these companies will start paying dividends. I'll give you some examples. Apple. Apple started in 1977. Do you think they paid dividends immediately? No. Then they got big and things were going okay. I assume they actually started paying dividends before everything went to hell. And then, of course, they stopped paying dividends. Steve Jobs comes back, and it takes a long time again before they're willing to pay dividends. You can look at all of the tech firms. They're all that way. Does Tesla pay a dividend? If I had to guess, they're not paying a dividend. But do people expect them to eventually pay a dividend? Absolutely, or the stock wouldn't have a positive stock price. Does that make sense? Okay. Now, let's talk about zero dividend growth. We've already said it's also known as constant dividends. It's a good model for preferred stock. This is our first time talking about preferred stock together. Preferred stock pays the same dividend every period. Now, we're going to discuss that it's not guaranteed, but it is the same dividend in every period. As a result, we can use the perpetuity formula. If you remember the perpetuity formula, it was just present value is equal to the cash flow divided by the required return. Well, all I've got to do is substitute P sub 0 for present value, and D for the dividend, and R for required return. It's the same. And that's going to give us the present value of all those future dividends. By the way, notice that the price is at time 0. The dividends start at time 1. Okay, now let's talk about what happens. That one's really easy. Let's talk about what happens when we have constant dividend growth. That's where the dividend grows at the same rate throughout all times. And this actually can be a model for some types of corporate common stock. For example, electric utilities. Now, it's not perfect, but it's a good approximation you could use to value an electric utility. Now, if we look at the stream of payments that we're discussing here, they look a whole lot like a growing perpetuity, which is just a set of payments growing at a constant rate throughout all time. A couple of differences here in the formula between the last one and this one. First of all, notice it says D1. That's the dividend at time 1. Why couldn't I just say D here?
This is different.
Yeah, because D1 is different from D2 is different from D3, because after all, they're constantly growing. So I have to specify which one. Notice that it's the dividend after the time at which we are trying to figure out the price. If I gave you D3 and you use this formula, it would give you P2. Okay, now we've got D1 divided by R. We know what R is. What do you think G is? The growth rate. By the way, R and G must be decimals. R and G must be decimals to make this formula work. Now, one more thing. R's got to be greater than G. What if G was greater than R? The bottom would be positive or negative? Negative. D1's positive. If you take a positive divided by negative, you get a negative. Is it possible for share prices to be negative? No, why not? Because they just wouldn't. Well, it's limited liability, right? Limited liability is what makes stock prices never go negative. So we know that's not going to work. Now, what if R was exactly equal to G? The bottom would be 0. Now, if you ask a mathematician anything divided by 0, they will tell you it is undefined. If you ask an engineer, anything divided by 0 is infinity. Either way, not going to work here. And so that's the rule, that R's got to be greater than G. Now I have students that say to me, well, wait a minute, what if G is greater than R? It won't be for this long time period. We'll see next time, though, that for short periods of time, G can be greater than R. And that's where we'll start next time.